I'm Hunter Thompson, and welcome to the Cash Flow Connections Real Estate Podcast. How's it going, everyone? Welcome back to the show. Today, we've got Keith Weinhold here, who is an expert when it comes to buying assets, growing wealth. By the way, not paying a ton of taxes, which is all the things we love to do in real estate and getting that appreciation. So Keith, welcome to the program.
Oh, thanks so much. It's good to be here, Hunter.
So I know that you run the Get Rich Education podcast, which is awesome. I wanted to talk to you on this show. I want to start off by getting your story and your background. From our email exchange, you mentioned you want to talk about how to get into real estate with a bang. And so I don't actually know what that refers to. So I'm excited to learn. So I'd love to learn more about your story and then how you made this transition. We can talk about some of the tactics of real estate investing.
Yeah, we sure can do that because I didn't always start off this way. I serve on the Forbes Business Council. And yes, I host my own platform called Get Rich Education. Like you said, I just really want to tell your audience, Hunter, that you need to be ready to hear some things that you haven't heard before. And if you think about it, that would make sense because building durable wealth, that would take a different set of thoughts and actions than what the mainstream does. I mean, hopefully you, the audience, would agree that that's true. But as soon as you tell people what those concepts are, they say, well, wait, whoa, I'm not ready for that. So the point is you really need to put yourself in the mindset frame of thinking differently. If you're going to do something extraordinary, you can't merely think and act ordinary. So with that backdrop there, Hunter, yeah, I mean, I was an employee just out of college. I had a humble bachelor's degree in geography. And when I had my first ever job, I just invested in a 401k in a set of mutual funds like I think a lot of people do. Because, I mean, back then my mindset, I didn't know anything about real estate investing. It was, well, wait a second, like stocks and mutual funds return 10% per year, no hassle. Real estate only gives you something like 5 or 6% a year, and you have all these hassles. Why would anyone get into real estate investing? But I kept hearing about how real estate has made more ordinary people wealthy than anything else. And as I learned more, the action that I took, Hunter, is when I had that day job, before I retired from it, I learned that you could buy a fourplex building, an entire fourplex building, with just a 3.5% down payment and an FHA loan. This is a program that still exists today. It's a great way to start with a bang. How I began. At last check, you only need to have a minimum credit score of 580, and you just need to live in one of the unit for at least 12 months. You need to be an owner occupant. And you can use this program with a single family home, duplex, triplex, or fourplex. So the fourplex is the largest building that you can do it with. And I had two friends that began this way. You know, hearkening back to the old Jim Rohn quote, you are the average of the 5 people that you spend the most time with. You know, 2 of my 5 friends had this entrepreneurial ambition to start off with a fourplex. So that's how I began, with a bang and a tiny down payment because I didn't have a lot of money. That 3.5% down payment, I lived in one unit and rented out the other 3. And a lot of lessons came from starting off just that way.
Interesting. Okay. So, and what market is this in, by the way? Like, what city?
That was in Midtown Anchorage, Alaska.
Oh, interesting. Okay, cool. And so, you get this property. How did you source the property? How did you find which one you were going to buy?
I just found it through a real estate agent listing. And then soon I would come to find out, oh, this agent didn't really know anything about income property, something I couldn't detect until later. Agents, probably less than 5% of real estate agents, though they can do a good service, most of them don't know anything about, specifically income generating property. And I didn't know where to look. Today, I would say, ask a property manager what rents you can get and about the operations of a building, not an agent. But I found it through an agent.
Okay. Okay, cool. And so how'd it go? I mean, you move in, what are the residents like? Do they know that you're the manager slash owner? I'd love to learn more.
Yes, a lot of, that's a funny thing, Hunter. A lot of people that own property, if they go visit their property, sometimes they don't want tenants to know they're the owner. Then the tenants will make all sorts of, ridiculous requests, or everything from fix this doorbell that doesn't work, or to what about that crack in the sidewalk. But I couldn't really feign not owning it when I am the on-site landlord, and I live there, and some of them physically brought the paper rent to my door. The very first day that I owned the building, one of the three tenants' water heaters had a crack and a leak, and it needed to be replaced. Just the worst luck. Starting off, it was on a Saturday. Okay, so like I closed on the property on a Thursday. It recorded on a Friday, and then on a Saturday, my first full day, her water heater leaked. I paid overtime rates on a Saturday to have it done promptly. I sure didn't know how to fix this sort of thing. I just wanted it to be over with. And you know what, though? That tenant ended up staying 4 more years because I proved to Beth and her family that, I was there to make things right. So it started off in a really rocky way. And you inherit tenants. That's something maybe a new real estate investor doesn't realize. If you buy a fourplex building, unless it's brand new, you're already going to be inheriting tenants, and a couple of them weren't screened very well. And, I'm the kind of guy where if a tenant tells me, yeah, I'll pay you the rent, it's just going to be a few days late. I'm like, yeah, okay, whatever. Well, they didn't pay, so I had to get rid of them. So sometimes you'll inherit bad tenants. When you buy a property like that, you're not just buying the property, you're buying the tenants and the reliability of that tenant's income stream in order to help pay that building's mortgage for you. But, Hunter, as I began to learn, um, this fourplex building taught me a really valuable lesson after owning it for a few years. With the way that I saw it appreciate, I bought it for 295K. 3 years later, I did a cash out refinance for 425K. That's a 130K gain. And again, I had only used a 3.5% down payment on this property, 10 or 11K for a 130K gain. I was getting a leveraged gain because I got the rate of appreciation on the entire building, the entire asset, both my 3.5% down payment and the 96.5% borrowed. And the real takeaway for me here, and going back to what I said at the beginning, Hunter, your listeners, they really need to open themselves up in ways of thinking differently. If you want to build substantial, durable wealth, don't focus on getting your money to work for you. Yes, you heard that right. Everyone's heard, don't get your money to work for you. Rather, don't just work for money, get your money to work for you. That's the part a lot of people have heard. But what this building showed me is getting other people's money to work for you is where the wealth is built. And I think some people have heard that before. But here's the thing, when you buy an income producing property with a small down payment, get a fixed rate loan, you're actually using other people's money three ways at the same time, ethically, do good in the world, just like I did with Beth, maintain properties and don't get called a slumlord. The first way you use other people's money ethically is by that bank loan and getting the leverage like I talked about. The second way is you're using the government's money for very generous tax incentives at scale. And then thirdly, you're using other people's money because you're using the tenant's money for the income stream to pay the mortgage and the operating expenses. So the lesson is, as blasphemous as it sounds, Hunter, don't just focus on getting your money to work for you. It's not a wealth building concept. Get other people's money to work for you three ways at the same time. That was the big lesson.
Well, I'm very sympathetic to that. As we talked about, I own raisingcapital.com. It's clearly the case that no matter how wealthy you are, what family you're born into, even billionaires raise money all the time. And the reason they do that is because it's the higher leverage activity, right?
Yeah.
So if you could have said, hey, you know what, FHA, I want you to keep the loan. I will buy the thing in cash. Yes, you could have done it, but the return on your investment would have been deteriorated dramatically. So let me ask you this. In that case, it wasn't that you had millions of dollars. You only put down 10,000 because you wanted to, or maybe, I don't know, maybe you did have millions of dollars. But the point is,
I didn't.
okay, so once you do start to build your wealth, and maybe I'm skipping ahead a little bit, how does the way you think about investing your money versus taking on debt or even, using other people's money, how do those dynamics change, or do they not change as you continue to grow in your journey?
Oh, that's a great question. As I've continued on in my journey, as I've added more properties in multiple markets, I generally want to keep a small equity position. So I begin with the minimum down payment. Therefore, I can borrow more of other people's money. And here's the thing a lot of people don't do. As equity accumulates in the property, I don't let it continue to accumulate, or like you said, my rate of return goes down. Since your rate of return is your gain divided by your amount invested, I want to keep that denominator from bloating and getting too big. And that might give some people pause. Is like, wait, so you're taking cash out of your property? You're treating your properties like an ATM? Yes, in fact, I am. I want to increase that velocity of money. When equity accumulates in a property and I do a cash out refinance, that is a completely tax-free event when I yank that money out of there. So, I mean, how do you get wealthy? You just buy assets, watch them go up in value, generally over time, and then prudently borrow against that and use those funds for more property if you like. And that does cause a loss in cash flow when I remove those funds. But as long as I have enough overall cash flow to service the debt on the property, I want to keep replanting those leveraged seeds into more properties. The rate of return from home equity is always zero. So I don't want too much of it to accumulate in any one property. So I've continued with this strategy.
Can I ask you a question about that? Can you repeat that? Why is that the case?
Yeah, how is the rate of return from home equity always zero? Oh, let me just give an example. If let's say you, the listener, you have a 500K home with 100K of equity in it, if your home appreciates from 500K up to 600K, let me ask, did it have anything to do with the amount of equity that you have in it? No, it didn't. Properties
No.
appreciate due to market forces. But yet, conversely, if your 500K property drops in value to 400K, the first thing to go is your 100K of equity. You have lost all of it. So the rate of return from home equity is always zero. And home equity is even worse than that because it's illiquid. You can't always access your equity. So there's something called the return on equity. That's a different calculation, but the return from equity, meaning is your equity itself generating a return? No, it has nothing to do with your rate of return. It's the market forces that do. And that's really a driving principle that keeps me from wanting to accumulate equity in any one property. And as you can see, since its rate of return is zero, the more equity you get in a property, the lower your overall return is going to be. I know that sounds somewhat blasphemous to some people. So we're getting counterintuitive here, which is what real wealth building takes.
Okay, interesting. So, and I'm just going to unpack it just a little bit because I want to make sure I
Yeah.
understand as well. So, is your view that as the home equity increases, you should be withdrawing that equity or borrowing against that equity so that your return on that equity can be material?
Yeah, I mean that's definitely up to the individual investor. Here's one thing I will say, though the rate of return from home equity is always zero, when you borrow against it, of course, that does bring up an interest rate expense. Say it brings up an interest rate expense of 7%. Well, then it's up to you to go out in the market and beat that 7%. Each time you do withdraw equity from one property and put it into others, you're also lowering your market risk. We talked about how appreciation rates change depending on the market. If I have a property that has a bloated equity position, I remove equity from it and put it into, say, two other properties. So now I've got three. Oh, those could be in three different geographic markets. So now I've reduced my risk. If I have the property in Florida and withdraw the money, then I can have property in Florida, Ohio, and Alabama, for example. So the market risk goes down as well.
Okay. I'm on board with that. I'm on board with
Yeah,
that.
yeah.
So,
And now
yeah.
for some might be like, well, wait, I bought my property like 4 years ago when interest rates were say 3 or 4%. If I refinance that whole thing now, I'd be paying like say 7 or 8%. That's not good. Well, a lot of times, and some people don't realize this, Hunter. I mean, you and I know this, but you can take out a second mortgage. So you can keep that first mortgage at its low 3 or 4% rate in place, making your blended interest rate on the property quite a bit lower. But this is all driven by that counterintuitive fact that, yes, the rate of return from home equity is always zero.
Okay, cool. I'm on board for that. And I think that the strategy of refinancing out and putting it into different deals, particularly in different markets, different strategies, maybe with different property managers, I think that's
Right.
not only a good strategy to reduce risk, I think it's a very good tax advantage play. And as you probably know, I mean, that's the way that real generational wealth has been created in this country is people that are able to play that game for the long haul and not constantly be buying and selling assets and getting crushed by taxes.
Yeah, and you know, Hunter, I'm glad that you've advanced this discussion because what have you done once again when you separate equity from one prop? Understand, no equity's lost. You're simply separating equity from one property and putting it into another property. You're not losing it. You're just transferring some of it. When you go ahead and do that, you've increased the overall leverage ratio on your entire portfolio as well. And yeah, like you mentioned, the tax efficiency, it's a non-taxable event. But the other thing you've done is when you separate equity from one property and use it as a down payment in another, you've effectively even used other people's money for the down payment on that new property because you got most of that from the leveraged bank's money, which helped create the equity position.
Got it. Totally love that. Okay, cool. Let's keep going. This is something that I'm quite interested in. So, um, down for that. Totally like that. What else you got? Because I'm learning now.
Yeah, I mean that's how I treat equity. Most people don't treat it that way. They try to get a paid off home. I don't prefer to have a paid off home. Even my primary residence is leveraged to the hilt. I practice what I preach. You can typically get better debt terms too on your primary residence than you can a rental property. And you're starting to understand like this is how wealth can be created quickly. I don't have to come up with my own money. I started off with a small 3.5% down payment and continue to do cash out refinances and 1031 tax deferred exchanges as well. How do you get all the equity out of a property? Because so far I've just talked about separating a piece with a cash out refinance. How do you get it all out of a property? Sell it with a 1031 tax deferred exchange. Another way to get tax efficiency as you grow your portfolio. Maybe you have a property that you don't like. It's a loser. Well, I wouldn't do a cash out refinance on that, or it would be less likely. I'd be more likely to do the 1031 then.
Makes sense. Okay, you know what? I know that this is a relatively basic concept, but I want to break it down for people because sometimes the listeners of the show they might already understand why doing cash out refis is something that they would want to do, but what they get caught up in is that they're so focused on being real estate investors because many of the listeners of the show are pretty advanced in this game, but they get caught when they're trying to talk to someone else that's not like a real estate nerd like you and I about why they should think about it or how they should think about why it might be a good idea to borrow money um, with their house as, let's say, collateral. Now, before we get into this, some people may there's this emotional element around their primary residence, which is why I love that you mentioned the primary residence being part of your strategy as well. One of my mentors, his goal is to have a very nice house, not going to say his name, but a nice house in cash. And, but he doesn't invest like that. So it's like this difference of like, I don't want my own house to ever be leveraged because in that case, I could never face a foreclosure if it's never leveraged. But why would you make the case? You know, understanding that it is a personal decision with everyone, why would you make the case that if I have a mentor that's going to have a two, three, four, $5 million house, why would you ask them or like have them consider why not apply some leverage there? You know?
Well, One's own home can be a different story because this is where emotions mix with numbers, and investing should be an unemotional thing. I have wealthy friends that have told me, Hunter, that they have a paid off home, even though it makes absolutely zero financial sense to have a paid off home. And you have a lot of things that intersect there, hanging Christmas stockings by the fireplace, the first day that you ever brought the dog home from the SPCA. You sort of have all these other feelings there. But on a mathematical basis, it probably makes less sense to have equity in your home. You're paying an opportunity cost because that's where you can get some of the very best debt at the lowest fixed rate that you possibly can. Now, if you're concerned that you're going to have cash flow problems and you couldn't make your mortgage payment because you don't have diverse enough income streams, all right, well then maybe that is a reason for keeping more equity in a property. It's just not the situation I've ever found myself in. I've found a way to spread myself out by doing just what I've talked about. So I think really it's making a homeowner aware that, hey, there is a financial opportunity cost of having equity in the home. It doesn't contribute to your appreciation or depreciation rate at all either. And those funds are illiquid. They are trapped inside the home. If you make even an extra $1,000 principal payment per month, say for a year, not only are you not getting a return on those dollars because they go into the home, they're illiquid. You might not be able to get those back. And in fact, if you, the borrower, you get into some financial distress, that's when you most need those funds that you already have trapped in a property. And guess what? The bank surely isn't going to give you any of them when you can't qualify because something has been disrupted with your income. So it's just another layer of risk by having them trapped in the property. They're illiquid dollars.
Makes sense. Makes sense. And another way of thinking about it is like when you borrow that money, real estate investors are accustomed to thinking about this concept of arbitrage,
Yeah.
where they can borrow money at a certain rate and then invest it at another rate. But some people that don't think like investors, typical, most people, by the way, doctors, lawyers, people working various jobs, they're not playing that game in the same way. So what ends up happening is they think about like the number of dollars they'll pay over a number of years, as opposed to thinking about the potential arbitrage opportunity. Or far more frequently, they'll think about the total dollars that they'll have to pay versus the time value of money and things like this. But the easiest way I would break it down is if I can borrow money at, let's say, a silly example, 2%. And I can literally go take the money that I'm borrowing at 2% and go buy US Treasuries at 5%. Obviously, anybody that's paying attention understands I will make money on that. Like basically that's the definition of a risk-free investment in today's, society. So it is a little bit of a education hurdle that you have to overcome with people that are not constantly thinking like that. But that's the way that you should be thinking about it from my perspective. Hey, listen, this deal that I'm putting in front of you is a 15 IRR. If you can borrow money, whether it's using your house as collateral or otherwise, at 5, 6, 7%, you can make the difference between the two. And if they need an extra layer there, you can actually show them the payments, right? So if you borrow $1 million at 7%, you're going to have to pay $70,000 a year. But if you take that $1 million and invest it in a deal that's going to produce 17%, you're going to make an extra $100,000 per year, essentially. Is that a fair summary there?
Yeah, that's a classic definition of arbitrage. You laid it out. Borrowing at a
Okay.
lower rate and investing at a higher rate. One point of caution, one red flag is okay, say you can borrow funds out of your home at 7%. And over here, you see you can invest it for a 15% IRR, internal rate of return, which I sort of think of as a total rate of return. That might sound good on paper, but if your finances are precarious and you borrowed out 7, and here over in this 15% total rate of return, only 2% of that is from liquid cash flow, but yet you need to pay 7% on your home, you can't pay the 7% rate with money that you borrowed out of your home or borrowed out of a rental property with just 2% liquid cash flow. So that is one of the warnings. Whatever you're investing in with borrowed funds, that needs to generate enough cash, or you need to have enough cash elsewhere in your life in order to service that 7% debt, or else that's where you could find yourself in trouble.
Yeah, I totally agree with that. And it's kind of like it's one step removed from what people do when they get caught up in the hype of market appreciation and they see their friends making money hand over fist and they think, okay, I'm going to feed the alligator, so to speak, so that hopefully the market will take care of me on the back end. I will be able to be in a good spot. The problem, though, is that many times that doesn't happen. In fact, the reason that you're having to come out of pocket to fund those monthly payments is usually indicative of the market being too hot. That's why people are willing to come out of pocket to buy those kinds of assets, because they're having FOMO. They're afraid that other people are making money and they're not. And so that pushes prices up to a point that people would be willing to come out of pocket. So I'm sure you're kind of following what I'm saying there as well.
Yeah, yeah, totally. And real estate as an asset class, it generates returns so many different ways. You know, you had brought up the internal rate of return, which I sort of think of as a total rate of return. Real estate pays five ways at the same time. And like, I wouldn't even purchase an income property unless I expected five simultaneous profit centers from it. So even if one or two of those profit centers are down, I'm still generating profits three to four other ways.
Yeah, makes sense. Okay, cool. Let's talk about the tax implications and how you're kind of playing the tax game. I'd love to hear more about how you think about taxes and when it's appropriate to take taxes and how you kind of roll gains into new assets and things like that.
Sure. And just to follow up on my last point, if anyone's wondering, those five simultaneous ways real estate pays are number one, leveraged depreciation, like I got with that first fourplex building. The second way is with cash flow. That's the rent income minus all your property's expenses. The third way is your tenant is paying down your debt for you with principal pay down. Remember, you don't pay your own debts. Your tenant's paying down your debt for you. The fourth way are those tax benefits, which I'll get into shortly. And then the fifth and final way is probably the least understood way. It's the inflation profiting benefit that you get on the fixed rate debt. You got $1 million in debt. The bank doesn't ask to be repaid in inflation adjusted dollars down the road. So if after a couple of years you've got 10% inflation, you only owe the bank back 900K in inflation adjusted dollars. And with 10% more inflation, 800K in inflation adjusted dollars as wages and salaries and rents go up over time. It's just another benefit of being a debtor, sort of the opposite of this equity position. But to get back to your question, Hunter, about the taxes and the tax efficiency, yes, the most tax efficient thing that I do, probably the greatest benefit to owning real estate, is that aforementioned 1031 tax deferred exchange, where I can legally defer my capital gains tax over and over and over again as I trade up with properties. And I can do that my entire life. So even though the 1031 is called the tax deferred exchange, you can make these deferrals over and over and over again all of your life, so that for you, it's effectively a tax-free exchange. So that's what I do when I want to get all the equity out of a property, maybe like a loser property, and move it into another one. Or I've even had, winning properties where I've done 1031 tax deferred exchanges because I can trade it up to something substantially bigger than the property that I'm relinquishing. Zero capital gains tax obligation. And in most any other investment, you're going to pay 20% or so in a capital gains tax, unless you have your funds in a tax sheltered vehicle like an IRA or a 401k. And when you don't pay any tax on that equity, that's more dollars that you can leverage. Leverage builds you wealth faster than compound interest. So you think about maybe you would have more dollars that you could use for compound interest because they're not taxed. But no, over here in the real estate world, you have more dollars that you can leverage, growing your wealth faster than you can with compound interest. It's the most favored tax vehicle that there is in real estate. In the Donald Trump 2017 Tax Cuts and Jobs Act, he did away with portions of the 1031 exchange. You used to be able to use this vehicle for farm equipment and some other things that were barred for use. But the 1031 for real estate continues, it perseveres, and it's probably not going to go away. A lot of people don't know this, but this has existed for over 100 years in the US tax code, where you don't have to pay any capital gains tax.
Yeah, I agree. And it does come up frequently where people talk about it and threaten that it's going to be gone. I'm not so sure that it's going to
Yes?
be, but it's important to fight against it because it would
Yeah.
really change the market of real estate in the United States. And it's a very favorable strategy. Um, I'd love to talk just quickly, if we can, about the retirement account stuff. Is that a big part of your strategy as well, or is that something that you stay away from?
No, I don't participate in retirement accounts. I used to back when I was an employee until I learned about real estate and all of its benefits. Even though it's not called a retirement plan, it's not a government sponsored retirement plan officially.
Okay, and is that also true regarding the self-directed stuff? You don't have it like tax-deferred accounts and those types of things?
I don't know.
Okay, and are you actually located? You're located in the United States, though.
Yeah, yeah,
Okay,
yeah. Born,
okay,
raised, lived my entire life in the United States, lived in Pennsylvania and Alaska.
got it. Okay, so I'm curious, is there a reason for that? Is that you believe that controlling it with outside of those things is favorable, and that maybe the control, the ability to do certain things overcomes the benefits of, like, let's say a solo K or something like that, or a self-directed Roth?
The benefits of real estate investing.
Oh, just like, the benefits of like a self-directed solo K, for example, or a self-directed Roth IRA, for example.
Yeah, I mean, Roth IRAs have pretty low contribution limits. I find my tax efficiency staying in directly owning real estate, not being the manager. I'm not a landlord. I'm not a flipper. I'm a passive investor. We're really just talking about buy and hold real estate here. Maybe I've talked about some concepts that are foreign about how leverage builds wealth faster than compound interest, or that the rate of return from home equity is always zero. But no, I'm not talking about really any highly sophisticated strategy here. I'm just talking about buying and holding real estate and doing it with plain vanilla loans, with 30-year fixed rate mortgage loans, my favorite type.
Yeah. Listen, if you can get into those types of loans and hold, I mean, it is really, really powerful. One of the things you just talked about, though, is the inflation stuff. I want you to go and kind of revisit that conversation because I think it's really important. And also, most people, when they think about inflation, they think, money coming out of their pocket. They think their
Yeah.
prices going up. They don't think about what it's like to be on the other side of that equation where you have an asset. Anyway, I'll let you kind of fill it in. I want to put words in your mouth.
Yeah, I mean, the inflation is a big part. Real estate investors win a term that I've coined called the inflation triple crown. You actually benefit from inflation three ways at the same time. And again, this isn't by doing anything sophisticated. A lot of people just aren't aware when you put a small down payment on an income producing property. Um, so why don't I give an example? I'll talk about the three ways that you benefit from inflation. I mean, inflation is an economic malady and it only makes most people poorer. But say that you put 200K of equity into, it could be a $1 million apartment building or say five single family homes that add up to $1 million. Okay, 200K down into $1 million worth of property. And let's say we have 10% inflation over time. It's probably going to take more than 1 year, but with 10% inflation, now your $1 million property is up to $1.1 million in value. It went up 100K. And you might say, well, so what? Aren't I right back where I started because I have 10% more dollars, but yet each one's worth 10% less? It's a break even, right? And the answer is no, because you made a 200K down payment. That also goes up 100K from 200K to 300K. That's a 50% rate of return. How did that happen? Because you got this 10% gain on both your 200K down payment and the 800K borrowed from the bank. So you benefited from inflation because you used a small down payment. The second of three ways that you benefit from inflation is that 800K that you borrowed, inflation eats into that. I touched on this a bit earlier, but your 800K as wages, prices, salaries, rents all go higher. That's going to get easier to pay back over time. Of course, your tenant is servicing that debt all the while, but with 10% inflation, owing 800K means you'll only owe 720K after 10% inflation. And then the third way a real estate investor benefits from the inflation triple crown is through rents. If we have 10% inflation over a few years, the money you feel in your pocket, your cash flow, might go up 20 or 25%. So you're beating inflation there, and you might say, "Well, wait, how could that be? Why is that?" And this is because your cash flow, which is all your rent income minus all your expenses, your biggest expense is your mortgage principal and interest, and that stays fixed. Inflation can't get in there and touch that because you're a savvy borrower. Again, another benefit of borrowing a lot rather than having a lot of equity in a property. So you just beat inflation three ways at the same time. Number one, with asset price inflation. Number two, with the debt debasement. And thirdly, with cash flow enhancement because your principal and interest payment stays fixed. So yeah, it's kind of funny, Hunter. When I go to Whole Foods and see wildly overpriced drinks for $7, part of me is like, oh, that's expensive. I don't want to buy that. But you know what? In the back of my mind, I'm like, this is exemplary of inflation. This is sort of proof that there's monetary inflation out of there. And I know that I'm the beneficiary of that because I own a lot of assets that benefit from inflation in just this way with the inflation triple crown.
Yeah, yeah, it's pretty remarkable. And, when you think about that, I mean, when I heard about this concept intuitively a long time ago, I also thought it would be like a wash because let's say you've got
Right.
gross income
Some people think
that's
that, yeah.
exactly, gross income's $100,000 a year. Okay, you got your expenses, everything goes up by 10%. It's basically a wash. But when you think about there's an expense ratio that's not 100%. It's not it's not that you are basically the same number of gross dollars is not coming in as also going out in terms of expenses. Usually it's 50% or so. So if you have $100,000 of gross income and $50,000 of expenses, and then you apply 10% to both of those numbers, the next year it'll be 110% in year two and 55,000 and 110,000 in year two and 55,000 in year two in terms of expenses. So you gain 5,000 and that's just in the first year. And then those numbers compounding each other over and over again. Something else though is that when you take this to its extreme, you see how favorable this really is. Like let's say that we had hyperinflation. Now that doesn't mean it's going to be good for the economy, but just for the purpose of this discussion,
Right.
hear me out. Let's say you had hyperinflation. You buy a property like a 100-unit property for $10 million and $8 million loan. You put $2 million down. And then you have hyperinflation. Well, at the end of the 5-year period, maybe $10 million now buys a banana. But that's what is owed back to your mortgage, or $8 million would be owed back to your mortgage. So you take something that the purchasing power is worth the same as a banana and say, hey, Mr. Lender, thanks for the loan. Here's your banana. You can sell it for 8 million bucks and now your loan is paid off. So that's kind of like a silly example, but that shows you how it is good to be on the winning side of the rich get richer, the poor get poorer, right? I'm not making the game. I don't want people to get poor, but given that may happen with inflation, I want to be on the winning side of that. And I want my listeners to do the same, which is why it's important to own assets that increase with inflation.
That's a good example. It's an example of how inflation transfers wealth from lenders to borrowers. So I actually do want to be a big borrower, but a lot of people don't because they think, oh my gosh, the interest, I don't want to borrow. I don't want to have all that debt. No, I think here's the mindset. You have reliably outsourced all of your debts when you buy a property where the income meets or exceeds all of the expenses, one of those being the mortgage principal and interest that your tenant pays for you. Again, inflation transfers wealth from savers and lenders over to borrowers. You wouldn't want to store $1 million under the mattress for 30 years because it might only be worth 300K after 30 years. But conversely, if you borrow that $1 million, it'll only have 300K of debt weight in inflation adjusted terms after 30 years. Just another reason I want more debt and less equity, as counterintuitive as it seems. I'm the one that has the control. And yeah, inflation is a really funny thing, Hunter, and a lot of people don't understand it. If Hunter and I were next door neighbors, we would be paying different rates of inflation. Why? Because if Hunter is a long haul commuter, well, then changes in the prices of gasoline affect him and not me. If I'm a vegetarian and he eats meat, well, then changes in the prices of meat affect him and not me. And you can never actually nail down just exactly what the rate of inflation is because If you buy a new laptop for $1,000, but your last one cost $1,000, but this one's twice as fast, well, did you actually get more and pay less for it? So there are quality adjustments called hedonic adjustments to make to inflation as well. You see it with food manufacturers. You're still getting a 20-ounce bottle of ketchup, but now it uses cheap sucralose in it rather than, a better sweetener or something like that. So inflation is really slippery, is my point. We don't really know what rate we're paying, but most people agree that these popular inflation measures that you see in the CPI and the PPI and the core PCE are all understated from what the true diminished purchasing power of the dollar is annually, but it's out there. So the point really here is inflation diminishes the quality of life for most people. If you position yourself like we're talking about with getting long-term fixed interest rate debt on an income property, you are the beneficiary of inflation. And it's interesting, Hunter. A lot of people want to know the future. Everyone wants to know the future. I do, you do. Jeff Bezos, the Amazon founder, he was recently asked up on stage, Hunter, what's going to be different in 10 years? And Jeff, he was, kind about it, but he said in a nice way, I get a little tired of that question. Really, the better question is what is going to be the same in 10 years? There are things that are almost certainly going to be the same in 10 years. So if we set our trajectory to hit what is almost certainly going to be the same in the next 10 years, we're going to be better off. It's almost like predicting the future. One of those things is inflation. We just don't know at what rate. Another one of those things in 10 years is the reason that I'm in real estate. It's going to be a primordial human need 10 years from now, just like it is today. So I want to be in something that's going to be around, is sustainable, and it's really non-discretionary. Everyone needs housing, and everyone is going to participate in inflation. We really don't have a choice in any of these two things.
Makes sense. Listen, this has been super helpful. Before we jump off, though, I'd love to learn just a little bit more about how people can learn about you, your business, your podcast, and how they can follow up.
Thanks. Listen to the Get Rich Education podcast. You can find it in all the normal places. We're really one of the first ever real estate investing shows coming at you every single Monday without fail since 2014. We talk about a lot of the concepts that Hunter and I discussed today, and we help match you, the listener, with the property that's going to be right for you and generate income over time. You can buy it however you want to. We typically recommend and tout the benefits of typically putting a 20% down payment on a 1 to 4 unit property in investor advantage markets in the US, Midwest, and South. Why are they investor advantaged? Because those are the states where you have laws that tend to favor the landlord more than the tenant, like you can get a quick eviction, and places in the landlord and rather Midwest and South also have a high ratio of rent income to purchase price. So we talk about all these concepts on the Get Rich Education podcast.
Love it. We will link to that in the show notes page. Hey, listen, Keith, really appreciate you coming on. Thanks again.
Thanks for having me, Hunter.